Anyway, now let's go to my favorite chapter of the book. I must say that the feedback I've been getting is that chapter 3 and 7 are definitely the best.
Yep.
And let me tell you why traditional portfolios are missing something, right? If you look at the equity bond correlation the last 120 years, it goes from minus 80% to positive 80%. We talk about 60/40. It's not really a reliable diversifier, especially with crashes, right? 2008, 2022, everything fall. The model breaks, right? And of course, all that theory kind of ignores that, you have investors, you have timelines, liquidity constraints. And another thing is like, everyone tells about, put everything in equities.
Yeah.
It's a dangerous thing, especially when you have some drawdowns. So you have this goal-based investing, which, and this was the book of the three and what we wrote. You have this, you have the MPT, the CAPM, the APT model, Markovits, right? They ignore completely investors. You had the second generation of portfolio management, which was looking for alpha, factor investing, right value, momentum, quality, etc. And then I believe you had this third generation, which is goal based, which is bespoke to each client. And in this book, I think it's the first book that actually used structured products in this goal based investing theory.
What do you think is the trigger between that second and third generation? What's
The
kind of
trigger?
changed in? Yeah, so what's kind of changed to start that?
I mean, there are a couple of things. One, I think it's technology. Right, it was very difficult in the past to be able to compute, especially bespoke portfolios to investors. Of course, for high net worth individuals, in family offices, they can do that, right? They have the money to invest. But for let's say for more the retail space, it was too expensive. And then the second was, investors are much more demanding, right? It's the one size fits all doesn't work. And I think that's what has been pushing this new way to thinking. And of course, especially financial advisors, financial planners. Again, financial planners now exist as a profession because you're trying to plan for the individual client. So MPT and alpha factor, although it can be used, it doesn't really fit to a plan, a life of someone.
Makes sense. Yeah, definitely. Okay.
So here you go. The framework which I think advisors could use is basically identify the objectives of each client, targets, the monetary targets and timelines. Goals must be measurable, not vague. Aspirations, of course, you can tell it. It's your dream to win the Euro Millions, but that's the probability of that happening is very, very low. So you could actually do that. There's some goal based investing that justifies investing on lotteries because with it. Assess the risk per bucket, and I'll show you, and then of course monitor and adjust because portfolio as well as targets and timelines change. So it's something that it needs to be live.
Mm-hmm.
And then I think it's important to that why behavioral finance supports the structured products, right? Because you have the prospect theory and loss aversion, capital protection addresses loss aversion. Because the investors know what's their floor, what's their worst scenario, and then you have that payoff kind of replaces the vague and uncertainty on outcomes.
Yeah.
And that kind of helps people going from the intuition to more reasoning, especially the mental accounting, which bucket own structured products. It's much more natural for investors.
Yeah, I think the pair of scenarios, I think with the current regulations going in, it's very obvious to see what your payout is on maturity or throughout the life of the product.
Yeah. Anyway, There you go. And then you kind of build a portfolio. And again, we talk about you need to find the goals, rank, select the instruments. Doesn't mean that you always need to buy structured products. Quite the opposite. And I'll show you. I'll show you I do actually. For some clients, you do not need structured products, or you shouldn't. But anyway, it's very good to select and size and kind of select the right structured product into the buckets. And of course, like measuring performance in the right way. Of course, I use the daily performance, so it's comparable with other asset classes, but it's what you expect. It is the intrinsic performance. That's what you need to do to evaluate.